Good morning. My name is Aditya Pattanaik. I'm an investment advisor at Sprott. The following excerpts are from a discussion I recorded with Rick Rule on the 21st of April, 2023. Rick, we've spent a lot of time on these calls emphasizing the idea of thinking about the price of a commodity in relation to production economics to get some sense of where we may be in the cycle of that commodity. We've also talked about how monetary metals are a little bit different in this regard. Now, if I think back to when we started recording these discussions in July of 2020, when gold was first approaching that mythical $2,000 level, there was nothing at the time from a fundamental point of view that would have led me to conclude that the gold price was about to stagnate for the next 2.5 years. Now, with hindsight, there have ended up being a string of catalysts that have caused this, but the fundamentals that we were talking about in terms of gold's bull thesis that were present in 2020 really are still very intact today. So directionally, gold has now potentially resumed an upward trend, and a sustained breakout in gold prices to new all-time highs, especially in US dollar terms, has become a discussion point again. So while on an inflation-adjusted basis, we're still not near the all-time highs of the 1980s, in a nominal sense with gold above 2,000, where we far exceeded a gold price justified by production economics. I was interested in your thoughts as an investor. How do you think about the price of gold from here on in terms of which innings of this bull cycle we may be in?
I guess I have three observations. The first is that in my own account, I don't look at the gold price going back to 2020. I look at it going back to 2000. In 2000, that was the period of time when I made the structural decision to add bullion to my portfolio. And the gold that I added to my portfolio in 2000 has done precisely what I asked it to do, which is to say, albeit with some volatility, it has maintained the purchasing power in my account admirably. And so I would ask, first of all, that your listeners extend their time frames beyond that which is comfortable to them to that which is relevant. The second broad point that you made is that the economic circumstances that were present at the first breakout in your discussion in 2020 and today are very much intact. I would say that they're more intact. I would say in 2020 that you could anticipate US dollar inflation because of US debt and deficits and quantitative easing, but you hadn't experienced inflation yet. 2023, that's very different. You are seeing, even in the government measurements of inflation, deterioration of the purchasing power of people's savings and investment instruments at levels that are beginning to be scary. 6.5%, excluding food and fuel, closer to 8%, including food and fuel, even with fuel prices falling as we speak. So I would suggest that the portent of the debasement of the currency, or the portent of the symptom of the debasement of the currency, was present in 2019 and 2020, and that was responsible for the then breakout in the price. I think we're in the early stages of the reality now. And so I think that an upside breakout in gold, assuming that current conditions continue, is much more proximal than it was then. Aditya, you always have to take into account the fact that what the Fed is doing might work. It might be that higher interest rates cool inflation to the extent that they can engineer a soft landing and return, as a consequence of a weakening of inflation, to real interest rates. By real interest rates, I mean a period where the interest yield, the nominal interest yield in the U.S. 10-year Treasury, is greater than the risk of inflation. For those listeners who believe that, they should avoid gold. I don't happen to believe personally that any of the conditions present for higher gold prices, namely quantitative easing, and by the way, the bank bailout was all about quantitative easing, debt and deficits, and negative real interest rates, I don't believe that any of those three factors are under control or in any danger of being under control. So as a consequence, I'm personally bullish about the gold price, and I'm more bullish about the gold price than I was in 2020, simply because the manifestation of the circumstance that was in place there is in the market now, and people are concerned about it, even the Fed.
One of the striking things about gold as an asset class today is something you've pointed out many times, is about its ownership. Whether you look at it from a central bank perspective or from an ETF or an investor ownership perspective, it is historically underowned. And you've pointed this out in many of your discussions. Now, there is a possibility that the role of gold as an asset class across the world has changed over the last 40 years. But there's also a small possibility that history is about to rhyme in some form in terms of a reversion to higher ownership levels that were seen in the past, or close to levels that were seen in the past. Now, we seem to be headed into a more multipolar world from a global reserve currency perspective, given all that's been happening in the world of late. And unlike the last time when we switched over from the British pound to the US dollar, there doesn't really seem to be an obvious winner this time around. So do you see this point in history as an opportunity for gold to win back its status as a key component in the reserve currency mix? Or do you think the regime change in fiat that may fall out of all of these monetary policy excesses of the last few decades will be resolved with some kind of new fiat-based system?
No, I believe that the end of the hegemony, the beginning of the end of the hegemony of the US dollar will be good for gold. I think that you're seeing a resurgence in interest in gold from one of gold's most prominent enemies, which is to say central banks. I think you're seeing that because of gold's traditional role as both a store of value and a medium of exchange. Remember that when the Chinese buy a US Treasury, they're buying a promise to pay. They're not buying payment. When they buy gold, they aren't buying a promise to pay. They're buying a payment in and of itself. And I think that you're seeing a resurgence of central bank interest in gold precisely because of gold's attributes relative to other savings and investment products. You're seeing a resurgence in gold interest among central banks too because of simple arithmetic. The Chinese, among other things, can add and subtract. And when they look at the interest they were getting paid on US Treasuries, relative to the rapid depreciation of the purchasing power of that Treasury, it became clear to them that in addition to the geopolitical risk that they were running with US Treasuries, they were enjoying, if that's the right phrase, a negative real return around that. For those reasons and the weaponization of the US dollar, it's very obvious that countries that oppose the hegemony of US political and social beliefs would turn increasingly to gold rather than US Treasuries as their reserve component. Separately, and we've talked about this before, Aditya, as little as those countries trust each other, and despite their warm words for each other, they trust each other less. And at the same time that the Chinese aren't particularly interested in holding US Treasury securities, they would much rather hold US Treasury securities than Argentine or Russian or Iranian Treasury securities. The answer to all of that, in at least some small measure, is gold. And I believe that some of the same rationale that went into the decision to buy gold for central banks will go into the decision for individual living, breathing human beings. In particular, of course, the arithmetic discussion, which is to say, why would you buy a savings asset that guarantees you a lower standard of living in the future? That doesn't make a lot of sense to me. And in the process of selling that asset class, which is to say long bonds, why wouldn't you consider some allocation to an asset class that has a centuries-long track record in shielding investors' purchasing power against the depreciation of the currency? I think, too, Aditya, it's worthwhile repeating the statistic that you alluded to, which is to say gold's market share. Gold in the U.S., if that's the right phrase, and when I say gold, I'm using it as a phrase to cover precious metals and precious metals related investments, comprises less than 0.5% of the savings and investment assets among the American public. The 4-decade-long mean is over 2%. If the deterioration in purchasing power of the dollar, particularly relative to the interest rate, and debt and deficits, and quantitative easing becomes more apparent to people than it has been over the last 40 years, my belief is that demand for precious metals and precious metals-related securities will at least return to the 4-decade mean. And if that is true, demand for precious metals and precious metals-related securities will at least quadruple in a fairly important savings and investment market worldwide. It's worth noting, too, that when you talk about gold achieving in nominal terms record prices, you need to qualify that with two facts. The first is that in most currencies in the world, gold has already achieved record returns. The U.S. currency, as poorly as it's performing relative to goods and services, has performed very well relative to other currencies, which means that in many currencies, gold has long since eclipsed its nominal highs. The other, as you pointed out, is the difference between the nominal pricing and the real pricing in US dollars. While gold is flirting with the $2,000 level in nominal pricing, if you look at the purchasing power of the dollar, you will see that in real terms, gold is still substantially below historical pricing highs, which, by the way, I think will be eclipsed both in nominal and real terms.
Yeah, it's interesting when I look back at the chart, at a 50-year chart of gold in terms of its share of total central bank reserves. I was surprised to find that it was close to 50% in the 70s and the 80s, and that share is now closer to, I think, 12%, while that of the US dollar has gone up to 50%. So, the lack of an obvious replacement, I wonder how that hegemony that you talk about, how that manifests itself, or the end of that hegemony rather manifests itself.
Well, it's worth noting that in the 50s and 60s, gold enjoyed declining market share as an asset class among central banks. It was only after that debasement of the US dollar beginning in 1967 when de Gaulle commented on the exorbitant privilege that the United States enjoyed by exporting inflation and the subsequent deregulation of the gold price, that the gold price ran, and as a consequence of it running, that the central banks used the pricing performance of gold to justify the narrative, which is to say that gold achieved a 50% market share, both as a consequence of the organic growth of the value of the gold in central bank depositories, but also because as gold became more expensive, it became perversely more attractive to central bankers. I have argued with you, Aditya, and with your audience, and I don't mean that in a negative sense. I have stressed, I guess, that we've been through an extremely benign period in the 1982 to 2022 timeframe. Globalization, declining real interest rates, demographics. My suspicion is that benign time is over. Not that the world's going to come to an end or anything like that, but the period of time that favored U.S. hegemony, that was punctuated by lower real interest rates, the benefits of globalization, the benefits of demographic and racial inclusion, all of the things that propelled us to 40 very benign years and caused us not to worry about much and hence not to need much gold, I think are over. And I think that the stresses that we're going to see, the geopolitical stresses, the economic stresses, the demographic stresses, the social stresses, all of those things will mitigate in favor of higher gold prices.
Now, gold prices have breached $2,000. And when we spoke about this last week, we were talking about how at $2,000, the price of gold is above the incentive price for the sector. And where the price goes from here on is, in some sense, it is almost a floating abstraction. Now, if I look at the gold miners over the last 3 years, whether I look at Barrick or Endeavour or Equinox, what I noted was that their average realized price was between 1750 and 1800 per ounce of gold on an annualized basis. The all-in sustaining cost for the sector is generally below this $1,750, $1,800 level. So as you're seeing gold prices breach 2,000, the margin compression, which a lot of these companies experienced over the last 2 years, following on from cost inflation, supply chain issues, labor shortages in the back of COVID, is now slowly going away. So the sector is setting up for a significant re-rate in terms, at least in terms of margins that they will be enjoying if gold prices hold up at these levels. Now, if I look at it from the perspective of markets working and markets being efficient and forward-looking, there are a number of segments in the gold market today, the intermediate producers and the developers, which you've pointed out are historically cheap when you look at them on a PNAV basis relative to spot prices. There are certain segments like the senior royalties, the low-cost producers in West Africa, which are responding to the price of gold, but there are many gold companies which are not responding to the price of gold from a valuation point of view. So on the one hand, you have low valuations and weak inflows into some of these segments of the mining sector, of the gold mining sector. And on the other hand, you have a gold price, which in a historic sense is close to its nominal highs, and which also exceeds the incentive price for the sector in general. So the question for you is, how are you interpreting the idea that you've talked about, that markets work, in the context of the gold mining sector today?
Well, I think that markets do work, but I think markets are messy. I don't think that markets are, in the time frame that most investors exhibit, efficient. And I'm not sure that markets are forward-looking either. I think that markets attempt to be forward-looking, but I don't actually believe that markets are forward-thinking. I think that investors, if they understand a forward-thinking narrative, don't have the courage to jump on it until the price action justifies the narrative, at which point in time most of the opportunity is out of it. I hope you understand the comment that I just made. And I think an important part of participating in the fact that markets work is the need for patience. The precious metals markets make you no money at all or torture you for fairly long periods of time. And then they make you an extraordinary amount of money in a very compressed period. And given my own personality, my psychological unwillingness to at least willingly overpay, if I do miss the early part of the upcycle in a gold rally, I likely miss a lot of it because I'm so angry with myself for not getting in at the bottom. The consequence of all of that for me is that I have to be early in order to participate. In this circumstance, early for me probably has meant 2 years early. And I'm okay with that because using any reasonable time value of money, particularly the time value of money that's appropriate over the last 2 years where real interest rates and nominal yields were very low, the amount of rent that I anticipate being paid when the market reacts to the circumstances that I see in front of me will be sufficient to overcome the fact that I've had to be in the market with very little action, at least positive action, for the last 2 years. I agree with most of the statements that you've made I'm not sure, however, that the juxtaposition between the price of gold and the all-in sustaining costs is as valid a determinant of production in the gold business as it is in other sectors. Remember that that's partly a supply-driven question. Almost all the gold that's ever been mined is still supply. And in that sense, gold is very different than any other extractive material that you and I might follow. And we need to look at things a little differently than we do other mined materials. In other mined materials, when the product price is substantially less than the cost of production, either the price rises or the availability of the material goes away. The availability of gold doesn't go away because the gold that was mined by the pharaohs is still in the vaults. Similarly, when the price increases, the ability of the industry to increase production relative to demand is constrained too. So that part of supply and demand, the part that's so important and will be important in the uranium part of this discussion, is less important than it is for gold. From my own point of view, and it was partly looking at the Barron's Gold Mining Index chart that caused me to do this. As a 70-year-old guy, a retired guy, a relatively wealthy guy who doesn't spend much money, I decided a couple of years ago that I didn't really, for most of my exposure in the gold equities market, I didn't need to outcompete the market. What I've looked at in prior gold bull markets is that the gold equities, when they advance, give you 400 or 500 or 600% over a few years. At age 70, that's more than enough for me. So for my own decision making, I decided that for at least 75% of my gold portfolio, that I wanted to capture beta, or even 85% of the beta, but I wanted to de-risk my beta as much as I possibly could, which meant that I went for very, very high quality companies. This was partly a reflection of where I saw my own needs relative to the market, but it was also partly a reflection of the fact that for the first time in my life in 2020, I watched a gold equities bull market that wasn't led by the biggest and the best. It was led by the most speculative. I still don't know why that's true, but when I looked at the lack of risk premium in the more speculative stocks relative to the lack of risk premium in the highest quality stocks, on a relative risk to reward basis, I found myself more drawn to the higher quality stocks and less drawn to the lower quality stocks. As you know, Aditya, I've had a lot of cash sitting on the sideline waiting to participate in private placement bargains for an industry that describes itself as being in a cash drought. But the lack of availability of high quality private placement product in the gold exploration sector has been striking to me. For an industry that describes itself as capital short, the terms on which the better of the more speculative companies has been able to attract cash, their ability to do that has been so good that I've in effect been priced out of the more speculative part of the market. I guess the third comment I have is that you and I have talked now for some years about the fact that another merger and acquisition cycle in the gold industry was inevitable. We anticipated that the balance sheets of the participants would have to improve. They would have to pay down some of the debt that they had incurred. But two, they needed to be forgiven by the institutional investors for the idiotic decisions that they made in the decade 2000 to 2010. They needed to get permission from their shareholders to do something other than merely return capital to those shareholders. I think now we are early in that M&A cycle that we talked about 2 years ago, 3 years ago, 4 years ago, and 5 years ago. You look at the sort of mooted takeover of Newcrest by Newmont, or the very successful recent acquisition of Sabina by B2, and you see, I think, the beginnings of an M&A cycle in resource companies in general, but in the gold sector in particular. And I think the two things, maybe the three things, that have the potential to ignite the sector are, in order of their relative importance, the leverage of the gold price up, given the investment attributes of competitive products like the U.S. 10-year Treasury. That's A. B would be the industry's realization and the investment community's realization that mergers and acquisitions are going to have to occur, both because companies that have underinvested in productive capacity will run out of material, and also because of the truism that larger companies are more liquid, enjoy a higher market cap, and hence a lower cost of capital than their competitors. And three, we haven't seen this yet, but the thing that kicks off speculative markets is a discovery cycle. We have not seen a discovery cycle, but I see early hints around discovery. And the speculative part of the industry moves on all three factors, which is to say an increase in gold price, which means an increase in the perception of the value of these companies' assets. M&A, a circumstance where, like Sabina, you get taken over at a nice premium, particularly if you get a double dip, a double bump, which is to say when B2 takes over Sabina, questions about B2's ability to increase their gold production go away because of the acquisition. It's possible in a circumstance like that. I remember when Glamis acquired Francisco, it's possible to get paid a premium when you get taken over, and then have the takeover be so accretive to the acquirer that you get a double bump, that the stock that you received in the takeover goes up too. That circumstance and the chance, I'm not saying it's true, but the chance that we're into another discovery cycle, or at least if we're not into another discovery cycle, that there are two or three discoveries that create value and whet the investment community's appetite, I think are the sort of things that could be responsible for a rebound in the speculative sector. Sorry for that long answer, but you asked me a lot of questions there.
Yeah, I got a lot of answers, so we can this can go in many different directions. What is interesting to me from what you've just said is that the catalyst for a re-rate in valuations, so companies that are historically cheap on a PNAV basis, the catalyst for that is M&A, which will be spurred on by gold prices staying elevated, and potentially capital flowing into the sector, causing new discoveries. So it's interlinked in a sense.
It's interlinked even more deeply than that, Aditya. A reasonable amount of money was raised in the sector 10 or 15 years ago. And although we expect exploration to respond to cash quickly, it doesn't. I remember the publication of the paper, The Alignment of Mineral Deposits in Northeast Nevada. That happened when I was a young student. It took the industry 6 or 7 years to apply that model to exploration in Northeast Nevada. And it took a concerted focus in exploration in Northeast Nevada, beginning in 1975 with the discovery of the Rain deposit. It took 10 years for the application of capital around the new model, the new exploration model for sediment-hosted gold deposits. to generate the massive discoveries that we began to see in the decade of the 80s that shaped Northeast Nevada. I'm not telling you this is a history lesson. What I'm saying is that periods of continued exploration success usually require a decade in the application of capital before they're successful. With regards to gold exploration in places like West Africa and the northern coast of South America, that decade is over, and we're beginning to see the fruits of that exploration. Whether it keeps going or not is a different question. But people have an expectation that the first year or two that they see an increase in aggregate expenditures in exploration, that it's going to make an immediate difference, and it doesn't. It's only a factor of luck. It takes a decade of concerted exploration spending in a district around a theme for that to work, and we're seeing that.
I think the expectation is also based on the commodity price.
Oh, that's very true. But I said there were three factors. They're interlinked, but I wouldn't describe them necessarily as one. I think personally, with regards to the gold price, that you alluded to the near-term problem with that at the beginning of this discussion. While gold is at or approaching its nominal high, it's approaching its nominal high in a dollar that's lost a lot of its value. So what that means is that you can have new nominal highs in the gold price, but inflation in the supply chain is such that your margin decreases. $2,000 gold in 2024 is different than $2,000 gold in 2020 because the value of the denominator has changed. You also point out, I think, that the gold price in nominal terms now is substantially higher, which means that you are going to begin, I think, to see margin increases rather than margin creep, but margin decreases from cost creep. But I also need to say, Aditya, and I think I've said this in many conversations that you and I have had, that a nominal $2,000 is not my gold price target. I have a much higher target. I'm not going to give you a specific target because I think it's a stupid thing to do. I can only say that quantitative easing is good for gold. That debt and deficits, while they're bad for the country, are good for gold, and that negative real interest rates are the best possible thing that could happen to gold. I will reiterate the fact that investors' perceptions around gold, investors of all stripes and all types and all ages and all ethnicities, have been colored by 40 years of benign economic climate, where the set of circumstances that would cause gold to have a really dramatic move haven't been present. But I believe that those 40 years of benign economic times, particularly with regards to bondholders, have changed. And while I'm relatively certain that the change won't come next week or the week after, what I have observed in now almost 50 years of watching gold markets is that when they do change, they change suddenly and very dramatically. And while that change may announce itself to other people, it's never announced itself to me. I've had to be in place anticipating it, which I am.
Two follow-up questions. The first one is, given what you've just described, the one thing I've noticed about, and I mentioned this earlier, the one thing I have noticed about the move in gold so far, or the gold miners so far, is that certain segments, like the senior royalty companies, the Endeavor Minings of the world are responding, but the rest of the sector isn't responding. Do you have any preferred ways of playing what you've just described as a potential
Well, I've already myself played the best of the best, which is to say, if you look at my portfolio, and you have, you will see Franco, you will see Wheaton, you will see Endeavor. They've been rewarded in the market because they've performed as companies. That's important. If you look at the performance of the Endeavor share price relative to the performance of Endeavor in terms of return on capital employed, margin, and the development of a development pipeline, despite their rapid production increases, what you'll see is that the share price performance, while admirable, actually hasn't kept pace with the corporate performance. And I think that's important. I think the second factor, Aditya, is that the traditional gold constituency is literally dying. They're my age. And the new money in the gold equities is much more often generalist money. And the generalist money is probably smart enough to understand that some of the subtleties that you and I might perceive in the market, they won't be able to perceive. And so they have to buy the best of the best. And the consequence of that is that when the generalist money comes into the space, it either comes into the biggest companies, irrespective of quality, or it comes into the companies that by conventional valuation methodologies, things like margin, balance sheet strength, are the best companies. And certainly you have been correct in noting that the share market performance has been from the Agnicos, the Endeavors, the Francos, and the Wheatons. Market leadership will eventually change, if I'm right. If the gold price continues to escalate and as interest in gold increases, the success enjoyed by the best of the best in a traditional gold bull market emboldens new participants to come into the market and look for companies that are relatively cheaper than the market leaders. At the same time, the companies that have been market leaders, that enjoy a markedly lower cost of capital than their competitors, take their competitors over, using high-priced paper to take over lower-priced paper, affecting synergies, but if nothing else, taking advantage of the cost of capital arbitrage is a time-honored facet of a gold bull market. And I think we're just coming into that. If I'm right, and I think I am, about the increase in the gold price, a virtuous circle happens then with regards to market cap. The first is that the margins increase because they can't help but increase, because the gold price increases faster than the cost to produce gold. But at the same time that happens, the investor perception around the gold industry changes. So by every financial metric, the companies get better at the same time that the market values that performance differently and more favorably than it has in the past. It's that convergence, I guess, of favorable factors that gives you the incredible upside volatility that was demonstrated in the Barron's Gold Mining Index that we reviewed so many times. I think I need to say, too, that people who are listening to this interview would be well advised to email you to get from you a copy of that chart, those people who haven't seen it, so that we can illustrate some of the points we've been making in this interview. It's one thing to hear dry verbiage, to hear narrative. It's a different thing to be able to look at that chart and see the circumstances that we're describing in very visual and very graphic terms.